More talk on credit card interest. Let me reiterate, you won't be paying any interest on your credit cards as long as you pay off your statement balance in full by the due date every single month, every month. So let's calculate credit card interest and I'll show you exactly how to do it. There's more to know about this interest rate fiasco with credit cards because when you make purchases with your credit card matters. The time, like the day of the month that you make them, it matters. Credit card interest operates in what's called the average daily balance method. And I'll explain exactly how it works. Let's do an example. Let's say you do end up carrying a balance on your credit card. And let's say it has a 20% APR. You didn't pay off your statement balance in full, and now you have a balance of $1,000 on your credit card because you didn't pay off the statement balance in full. You've opened up a big can of worms. So let's start the billing cycle at the beginning of the month, and we'll do a handful of transactions to make the math easy. Let's say on September 1st, you spent $1,000 on who knows what. It's your business. On September 10th, you spent $200. You had a $200 purchase, or you just spent $200 that day. September 20th, you spent $300 that day. Now, on the last day, September 30th, you spent another $100 for a grand total for this billing cycle this month, 1,600 bones. It's your total statement balance, 1,600. Clear? Nice. As mentioned, credit card interest works on what's called the average daily balance method. And the math looks something like this. You're going to take each day's total balance for that month and add them all together. So September 1st, remember we made that $1,000 purchase. And from the 1st to the 9th, the balance amount you had was $1,000, right? So you do 1,000 times the 9 days. This is the 9 days for your grand total of $9,000. On September 10th, you made that $200 purchase. You do 200 plus the 1,000, that's $1,200, and you had a $1,200 balance for 10 days. You had it the 10th through the 19th for a total of $12,000 here. 10th through the 19th, $12,000. On September 20th, you made that $300 purchase. The $300 is added to the $1,200 for $1,500, and you had the $1,500 balance for 10 days, 20th through the 29th. That's how much is you're being held. And then that is $15,000. And then September 30th, you had the $100 purchase, and then you add that to the $1,500, that's $1,600, and you only had that balance for a single day for $1,600. From there, you're going to add all of these guys up and divide it by 30. You're going to add up your balance amount, grand total balance amount, and divide it by the number of days across the board. So the total balance here is $37,600, and we're going to divide that by 30. So your total average daily balance divided by the number of days you had them. So your total balance, $37,600 divided by 30 days equals $1,253.33. So far, so good. We are just finding out what the average daily balance was throughout the month. Tallied them all up, tallied the balance average for all the days, divided it by 30. And this is the average daily balance that we held. Sweet. So now let's figure out how much interest we're going to be charged for that amount of money. At a 20% APR, we have to take 20 divided by 365. That's 365 days of the year. And we're trying to get the daily interest rate. So we take the 20% divided by how many days there are in the year, and we get 0.055. And then we take that 0.055 and we times it by 30 because there's 30 days in the month. So 30 times 0.055 equals 1.65%. 1.65% is our daily interest rate charge. So our daily interest rate times our average daily balance is how much interest we're going to have to pay. So $20.68. That is how much we'd have to pay. So each day that passes by, this daily interest rate is going to be multiplied times the average daily balance to give you how much interest you're going to have to pay back. And this is going to continue to grow if you continue to spend. And this is also going to continue to grow if you never pay your interest, because this interest is going to be added to that. Then you will pay interest on that. And hopefully you can see how it matters what day you make the charges on your card. When you make a payment onto your card, it affects your interest immediately because they care about how much the balance is for each day. For example, if you had a $1,000 purchase on September 1st and you paid $500 on it the next day, that would decrease your average daily balance because it would be lower for more days, thus affecting how your interest would be calculated at the end of the month. Also, I think you can see that this debunks the idea that if your APR is 20%, if you had a balance of $1,000, you wouldn't be paying $200 as soon as you were late on it. Keep in mind that this interest rate is compounding daily, as I mentioned. So the first day you have to pay interest, then the next day you're paying interest on that interest and interest on that interest. And the amount owed yesterday and so on, it's compounding daily. Even if it is only $20 in comparison to $200, the fact that it's compounding daily is why we want to jump on top of this and get rid of it as fast as we can. Hope that makes sense. Okay, concluding thoughts. Concluding thoughts are keep the average daily balance as low as possible. That's the takeaway. Try making big purchases toward the end of the month because then your balance is lower for longer, the average balance. But most importantly, get that statement balance paid in full every single month. As soon as you carry over a balance, the charges you make begin to get hit with interest instantly. Another thing to keep in mind in your noggin that I've stated is that you could carry over a balance of $1 and then make a $150 purchase on your card, and suddenly you're being charged interest on $151 instead of the $1 you carried over. No worries though, we will cover how to use a credit card responsibly so you avoid paying all interest. I will see you in the next one.